Good evening and welcome to the Earnings Review, your tidbits into company financials and operational insights. Thank you for joining us as we broadcast from Hampton Studios in Harare, Zimbabwe. I'm Ibn Mabunda, yo money man. On the show, we engage top echelon executives to get you up to speed with first-hand information. We also chat with the most competent analysts on the market just to ensure you're furnished with relevant and comprehensive market analysis. Tonight, we focus on Prospect Resources, a listed miner on the Frankfurt as well as the Australian Stock Exchange. Now let's get into some halajus where the firm is concerned. This is a battery minerals company that has investments in Zimbabwe and is known for its flagship project, the Arcadia Lithium project, in which it owns an 87% stake. This project is located 37 kilometers east of Harare in Zimbabwe. The group also has exposure in phosphate as well as gold mining, particularly in southern as well as eastern Zimbabwe respectively. But to zoom in for a moment in as far as their lithium exploits are concerned, this is one of the world's largest lithium resources and is estimated to be worth not one, not two, but 3.5 billion United States dollars. At its optimum, the project is expected to generate 75,000 metric tons of spodumene as well as 155,000 tons of petalite. Now, I want us to take a moment to look into the details that surround lithium as a sector, as well as some of the key factors taking place, bringing us to this very point of discussion. And sort of as a backdrop, lithium is a very key metal in this moment of history. To take you a few decades back, there has been growing clamors from international bodies such as the United Nations for the reduction of carbon emissions. And on the one hand, this spells the reduction in terms of the usage of fuel. And on the other hand, this spells potentialities in as far as alternatives which are more green friendly. This then brings lithium into a very strategic point, as this has seen a surge in the demand for lithium, as this of course is strategic in the creation of user-friendly rechargeable batteries which reduce carbon emissions into the atmosphere. Let's look at some of the uses that see a demand where lithium is concerned. Lithium is used in several uses across the globe, among them lithium-ion batteries, which constitute 45% of the global demand, ceramics as well as glass, which demand 27% of the metal, lithium grease 7%, polymers 5%, casting flax, which demands 4% of the global production of lithium. Among its uses would be its use in medication. And did you know that lithium is used as a component in the production of medication that is used in treating the bipolar disorder? Analysts estimate that by 2021, there would be an escalation in terms of the demand of the metal in as far as lithium-ion batteries are concerned, even up to more than 55%. But let's get into why there would be such an increase in as far as the demand for the lithium-ion batteries is concerned. Now, according to reports.valuates, the global electric vehicle market is expected to grow from 118 billion United States dollars in 2017 right up to $567 billion by 2025. That would pretty much spell a 22.6 constant annual growth rate. That's not all there is to the matrix. The global electric car chargers market size is expected to balloon at a constant annual growth rate of 29% from 1.7 billion United States dollars in 2017 to a figure of $13.1 billion by 2025. And this, of course, would spell a surge right there in the market for electronic vehicles. Let's look at some of the key players in that segment. Of course, this would be where you find the BMW Group, Nissan, Toyota, Volkswagen, General Motors, and of course, the New York Stock Exchange buzzword, the Tesla. Of note is the fact that Elon Musk is on record for having said, and I quote, "We would basically need to absorb the entire world's lithium ion production." This, he said, explaining the challenge that he has set for Tesla to produce more than 500,000 models of Tesla annually. Now, to look at some of the key producers in as far as nations are concerned globally, the leading producer would be Australia, which produces 42,000 metric tons of the metal, followed by Chile, which produces 18,000 metric tons of the metal. In position 5 would be Zimbabwe, which produces 1,600 metric tons. Zimbabwe's Mines Minister, Honorable Winston Chitando, is on record for having said that Zimbabwe has the potential to produce up to 20% of the world's demand for the metal. That's not all there is to Zimbabwe. Zimbabwe is home to the world's largest single lithium rock deposit. Now back to Prospect Resources. The firm recently completed the conduction of what is known as a definitive feasibility study, which is pretty much defining in as far as the progress of the firm is concerned. And I want us to look at some of the teensy-weенsies from that very report. With a requirement of a capital expenditure of 162 million United States dollars, the firm is expected to generate an annual EBITDA of $168 million in the first 5 years of operation. And of course, with a life of mine of 15 and a half years, the firm believes that it has a revenue generation capacity of up to 3.42 billion United States dollars. And what is also more exciting is the fact that this project has an internal rate of return of up to 71% from the previously stated 44%. Now, to look at their market capitalization on the Australian Stock Exchange, with the current share price of 14 cents, the firm has a market cap of 40 million Australian dollars. And on the Frankfurt Stock Exchange, it has a current share price of 8 cents and a market cap of 26 million euros. A notable development is the fact that the firm is currently in a engagement with Afreximbank for the extension of a credit facility of up to 143 million United States dollars. Now, this concludes the How You section of our show tonight. In just a moment, we will have a conversation with the mining chief executive or managing director, Mr. Sam Hossack. Now, don't go anywhere. Now joining us from Perth, Australia, is Sam Hossack, the MD for Prospect Resources. Hi, Sam, and thank you for joining us on the Earnings Review.
Thank you very much for having me. It's a great opportunity to talk to you about Prospect Resources.
Beautiful. To get the ball rolling, how are you faring with the COVID?
Oh, we're doing great in Western Australia, thank you. We've got matters as we see them largely under control. The disease is not impacting us directly, but it is affecting our ability to travel, which does impact us. And with our operations in Zimbabwe and our customers and our finance partners globally spread out, it is impacting us in that regard. But we are making up for it on the e-meetings, and we're able to say that we're getting by on it. So at this stage, we've been very fortunate. Thank you.
Fair enough. Now, to talk about your operations, how has the pandemic affected your operations that side, and of course here in Zimbabwe?
It's certainly impacted us. There's no doubt that all of our service partners, our finance partners, our customers have directly and indirectly been impacted by this. And as we, I guess it's a novel experience. So many of these institutions and businesses are adapting to their new normal. We're a small business and largely very adaptive, but the larger institutions and businesses that we interact with and are developing our business strategy through, they've definitely been impacted. And I think as we've seen them assessing the impact on their business, it's certainly taken some sort of toll on us. But we're largely pushing ahead with what we're doing, and we're finding that large business operations are continuing as normal now, and therefore, whilst it's a new normal, it's not impacting us in quite the way we were worried it would. Certainly, we're able to get a lot done in ways that previously we hadn't been able to. So it's positive in that regard.
I realize. Now, Sam, several potentialities that are on the horizon for Arcadia. With, of course, the Green Revolution, there is a growing demand for greener methods of doing things. And, of course, among them would be the lithium-ion batteries in a bid to reduce the carbon emissions. Can you tell us how important your recent listing on the Frankfurt Stock Exchange is concerned, particularly where the recapitalization of your operations in that regard?
Yeah, that's a very relevant point. Our business is very much focused on the electric vehicle and energy storage sector, and certainly in the last 6 months, and particularly in the last 4 months, we've seen a substantial impact on industrial activities. So we've seen a reduction in emissions globally, and we've seen lots of different, shall we say, markets, electric vehicle markets, adapting to that and recognizing that a reduction in emissions and industrial output that generates emissions does result in a cleaner environment. And so the EV adoption rate has certainly seen an uptick during this period, because I think it's appealed to people's conscience more clearly. And so we are very much, as a business, focused on energy storage and the glass and ceramics market. And to talk about them separately initially, I'll bring the narrative back together. But the energy storage and battery sector, the largest consumers, particularly the automotives in Europe, are very progressed in their move towards the electric vehicle fleet and the hybrid fleet. So we're seeing the Europeans probably the furthest ahead in terms of mentality and psyche towards the adoption of the electric vehicles and recognition of that impact on reducing emissions. So there's large tariffs and incentives in Europe, and large automotive producers in Europe, and therefore the EV concept and the green energy policy concept is very advanced in Europe. And so listing on the Frankfurt Stock Exchange has allowed us to access that capital market, where we would say the market is both sophisticated and very pro-EV. So that's been a real success for us, and continues to grow in its impact on our business, and certainly will lead to the capitalization of the Arcadia project. The second market that is consuming petalite products is also European. So we're selling products to the chemical market to be made into batteries, and we're also selling products into the glass ceramic industry, which is, as I mentioned, largely European based. So we're very European focused at the moment, with both our capital markets and with our customer base, whilst the EV chemical market is largely Chinese. So there's that diversity in our sales strategy, and Frankfurt has certainly allowed us to unlock the capital market potential of Europe. So that's been very successful for us.
Fair enough. Can you give us a bit of your perspective with regards to the prices of lithium? Word on the market, of course, the prices have not performed so well, of course, during the course of 2020. But there is an indication that we could see a surge in terms of the prices by 2022. What is your assessment where that trend is concerned?
That's the eternal question, of course. Naturally, there's lots of professional market commentators, market analysts that are in a much stronger position than I am to talk about the future and where that supply-demand balance will go, and its consequential impact on pricing. So we obviously follow a lot of the market commentators whose business it is to really understand consumers and production, etc. And generally, there's quite a lot of consensus that around the end of 2020, early 2021, the EV electric vehicle will cost fairly similarly to an internal combustion engine. So for us, this is described as the catalytic point. That's where a consumer of a vehicle has that optionality to have the same type of vehicle at the same type of cost, the same type of performance in either internal combustion or via electric vehicle and battery energy storage. So we see that as being a sharp change in uptake and demand. And of course, we have to recognize that the supply chain for electric vehicles, and particularly batteries, which is our focus, is a complicated supply chain. There's battery manufacturers, design and manufacturers, there's the inputs for those materials, which largely come from China. And then there's producers like ours, primary producers, that supply spodumene in a hard rock form. So, you know, what we've seen in the last 2 or 3 years, and what the commentators tend to agree on, is that there's been a consolidation of that supply chain as it's rapidly maturing. It's gone from, I think we've more or less doubled the lithium carbonate equivalent, which is one of the inputs into battery production, over the last 6 years. And I guess looking forward, it's set to double more than twice before 2027. So again, you know, the impact on pricing will probably be evident as demand outstrips supply. What we've seen in the last few years is supply and demand being in some sort of parity that drives down prices. So a bit of a soft market. And as we look forward and understand the impact of that low commodity pricing and future investment, we realize that there's been inadequate investment into primary production. And so I think we're likely to see another quite volatile uptick in pricing. As to when that happens, it's obviously not clear. But for Arcadia project and for Prospect Resources, we're very certain that fundamentals of the green energy policy and the EV adoption, you know, the fundamentals are sound, and our business model puts us right at the bottom of the cost curve of producers, meaning we are able to withstand huge amounts of market volatility and remain viable. So we're quite bullish about that, and we certainly, you know, draw a lot of confidence from the market commentators that see a large uptick in demand in the preceding or the next 2 to 3 years. So a little bit of commentary there, and certainly leave it to the specialists to actually apply cost and pricing.
Indeed, it looks very promising from that end of things. But let's take it back home to Zimbabwe, where we are seeing turbulence on the macroeconomic front. We are seeing soaring levels of inflation, a plummeting local currency, power crisis, the list being interminable. Question would be, how are you navigating these challenges that are playing out in Zimbabwe?
Well, Zimbabwe obviously offers its own particular flavor on economic backdrop, and certainly there are challenges that we face. But to speak about what we're doing successfully, we've got huge support from the Ministry of Mines, and we are able to, through that support base, navigate quite clearly any of the complexity within the macroeconomic market. So we're certainly facing the same challenges, but we see ourselves, particularly as a primary producer in the mining sector, as a large part of the solution to Zimbabwe. It needs a larger production base and a stronger fiscal platform, and Arcadia is going to contribute substantially to that economic output within Zimbabwe. And certainly we're confident that our project is recognized by the government of Zimbabwe and certainly the Ministry of Mines, and a certain importance is placed on that we value and benefit from in our process as we go through. So we've been very fortunate. We do struggle, of course, with the same challenges that you've explained, But through our support and through our team on the ground in Zimbabwe, we're able to manage largely the various challenges that we face. So, our focus is on being ready as a primary producer to meet the demands of the mining sector and the growth in mining output, and play a key role in that, so that we remain vital not only to the mining fraternity, but also to the people of Zimbabwe and our local stakeholders.
To take you up on what you just alluded to, recognition by government, how important is the special economic zone status that you got from government sometime recently?
Yeah, so we've had the special economic zone for over a year now, and it's had a big impact on our economic discussions and negotiations with our debt finance partners, AfricZim. AfricZim Bank are a large part of, important part of the DFI participation in Zimbabwe. And certainly the special economic zone offers a number of economic benefits to ourselves, and certainly security to our lenders. So it has been a massive benefit. It was set up to attract investment, and I can see that that's effective. And so we were very strategic in seeking to secure a special economic zone. We were also able to secure national project status. And so you can see through those initiatives, benefits, we were able to put our best foot forward and take advantage of the world-class asset that Arcadia has in Goromonzi.
I realize. Now, tell us, Sam, how important is your recent engagement with Sinomine as well as the AfroZim Bank in terms of the capitalization of your operations thereof?
Fundamental to the capitalization is really improving our offtake. So we do have Sinomine as offtake partners. We've also announced that we're under negotiation with a large consumer in the glass ceramic sector, which is Zimbabwe out of Europe. And so completing the offtake, in a sense, de-risking the project is a big advantage in the negotiations and discussions with AfricZim Bank. So we've been de-risking the project, working on the technical, metallurgical aspects, improving recovery, reducing production costs, and de-risking ourselves with regard to sales and securing those forward sales. So Sinomine have been tremendously helpful. They've been by our side, they're equity partners as well as offtake partners. So they've been a cornerstone in this investment, with which we're able to build a solid investment proposal to AfricZim.
Now, I think the most important question to this conversation today is, look, with a growing demand for EVs, Tesla is on seeking to ramp up production to 500,000 units annually. When do you expect to commence the mining of lithium in Zimbabwe?
That's a good question. Our focus obviously is capitalization of the project, and we've had a good conversation about AfricZim Bank, the premier DFI debt provider. The Southern African operations are based in Zimbabwe. A very great counterparty. We're progressing with them. With regards the equity into the business, which is I guess a key component in the final project finance. We've been under negotiation and announced quite recently that we've been discussing and negotiating this with Rosatom, Uranium One. Now they're a Russian business, they're a state-owned entity, and they have their own electric vehicle supply chain to secure strategically. And they've had a good look at all the other assets globally. And what Arcadia has, which is unique, is it has petalite as well as spodumene. Now, petalite currently goes into the glass ceramic sector, spodumene into the electric vehicle sector. But when you look at the petalite sales and look at them as a credit the spodumene, you end up being absolutely the lowest cost spodumene producer globally. And our intention is to back that up and investigate it and bring it through the studies. And we certainly put that forward to Rosatom. We understand that's an attraction for them. And their focus is to have at least 51% of our spodumene. So as negotiations with them progress, we have started to see an alignment between Rosatom and Afreximbank. Russia is a member state of Afrexim, and therefore have worked in close alignment with Afreximbank. So we're starting to see the debt and the equity completing together, and our expectations would be to complete that within 2020. We know that COVID's impacting both our businesses and our finance partners' businesses, but realistically, from financial close, which could be within the next year, what we expect is about an 18-month project duration before we're in a position to produce a sellable product. So in terms of mining projects and mining project timelines, that's very near term, quite frankly. And so our team is very focused on working on means to make that increase the viability and attractiveness to each of our debt and equity partners.
I realize. Just briefly, two things that I want us to explore as we round up. What informed the decision to dispose of some of your shareholding in the Arcadia Lithium project? So
we have announced close to 16 months ago the share swap with one of our minority shareholders, Farvic Consolidated Mines. The rationale there is to increase the holding of the parent company in the asset, and so that would take us from 70% up to 87%. And the minority shareholders in our agreement get a free carry, and so the increase from 80% to 70% to 87% is really to improve the economics of the funding and to make that less of an economic hurdle.
Fair enough. Now, also, I know that we've dwelt so much on your lithium prospects. Let's talk about some of your interests. There's the Panalonga Gold, the Gwanda East Gold Project. What's the progress where your operations are concerned on that front?
Look, we're very focused and have been primarily focused on battery minerals. And so we obviously understand that the business needs to focus on a single asset, and our view was that the lithium sector offers the best long-term strength. The Arcadia project is, I think, the seventh within the top 10 global asset sizes, so it's a very competitive global asset. And for that reason, we have focused on it very intently. The Panalonga project is still getting exploration attention and is still at an exploration level. And so our focus is primarily to develop the Arcadia project and then to follow through with the Panalonga project primarily. That's currently our strategy.
And as follow-up with several projects, of course, lined up in Zimbabwe, do you see any potentiality of you listing on the recently announced Victoria Falls exchange that has been announced by government recently?
It makes a huge amount of sense, to be honest. And we have we've put our hand up, and we are on the list for listing. So it would be a secondary listing. The importance of that would be to ensure that we're able to offer some benefit flow to our market. And we're very focused on Zimbabwe. We're very pro-Zimbabwe, and the opportunity to have a secondary listing in Zimbabwe would give us access to and provide access to many of the retail investors within the country. And so I think it's a great idea. It's a good initiative. And so it's on our radar. Yeah, we're lined up.
I realize. And also, I think at this point, since you have mentioned interest to list here in Zimbabwe, just your general assessment in terms of the policy. How confident are you in the policy framework that we've seen play out on the Zimbabwean side of things, particularly from a government perspective?
Look, our view is around stability, and mining projects, as I alluded to earlier, have a substantial time frame that they don't materialize as quickly as everyone expects or would like. So our time horizon is actually we have a long view, and our view is fundamental stability is as important to us as it is to the government of Zimbabwe and the people of Zimbabwe. So we look for stability in policy and require and rely very heavily on policy stability, and we can see that efforts have been made in that regard, and certainly that is a key attraction for foreign direct investment is policy stability. That's what we all need.
Fair enough. Can you elucidate in as far as your offtake agreement with Sibelco is concerned, and also maybe for the sake of our viewers, just to explain what an offtake agreement would entail?
Okay. Look, offtake agreements tend to vary substantially throughout the industry, and an offtake agreement is fundamental to a greenfield project like ours, whereby debt finance require the security of forward sales of products from that business. So for us, offtake partners are our future customers. They're going to buy our products, and quite frankly, the EV offtake framework is quite different to the glass ceramic framework. We're seeing the EV and spodumene sales and offtake agreements here in Western Australia into China have been quite long-term fixed volume contracts, whereas into the European glass ceramics market, they're more evergreen, and they don't run in terms of fixed pricing for quite as long as they do in China. So they're actually substantially different. Neither of these markets are a terminal market. These are very, in a sense, quite new minerals, and so our offtake partner, Sinomine, that's a classic EV chemical offtake agreement. We've forward sold a large portion, 41% of our spodumene and petalite for the first 7 years, and that leaves us with around 59% to sell into Sibelco and Uranium One. We know that Uranium One wants at least 51%, and so we're able to introduce a little bit of competitive tension to make sure we're able to derive the best market pricing for our products. So we do rely on these offtake agreements. We do intend to have majority of our product in the first 7 years forward sold on either fixed or some sort of floating mechanism that allows fair value, and that's certainly very important for the debt finance and closing that off.
And lastly, to sort of digress, we've seen other players across the globe, players in Chile who are into lithium production, as well as other parts of the world, sort of taking on a delay with regards to their expansion where the production of lithium is concerned. What would be your general assessment of the lithium industry, perhaps in a broader sense, getting into the close of 2020 into 21? Why do I talk about the close of 2020? Because there have been, of course, some delays on the pandemic that has stalled progress in as far as the uptake of EVs, among other key players or indicators in that very sector.
Look, to be honest, each one of those operations faces quite a unique set of challenges. There's some of those producers down in South America are lithium focused, some are diversified, some have larger balance sheets, some have a weaker balance sheet, some are achieving quality specifications, and they're very stringent, the quality specifications. The sort of value erosion of your product if you don't attain battery grade chemicals is is very, I guess it's a huge penalty. It's punitive. And so what we're seeing is some of those suppliers and producers are focusing on the technical enhancements and improvements required to improve the quality of their products. We're seeing some of the producers focusing on balance sheet strengthening, so they're not putting out the outlay on the capital expansions. And we're also seeing at the same time some of them moving to just dominate market share by increasing production. So there's certainly not one single response to COVID-19, and certainly each one of those businesses is bullish on the medium to long term, and facing short-term headwinds that generally are very specific to their businesses. So I think my response would be that the medium to long-term view on lithium demand and consumption is something that we're very confident on. And in the next 2 to 3 years, our focus will be on getting the production, of Arcadia to a point where we're able to produce the products we need. So it's we're in the development stage, and that's where our focus is. So we're pretty sure that in the next 2 to 3 years, there's going to be a slightly different market dynamic on this supply-demand imbalance.
Well, Sam, thank you so much for the insights, and thank you for joining us on the Earnings Review.
Sure. No problem. Well, thank you for having me, and thank you for the opportunity to present Arcadia Project and Prospect Resources.
Welcome back, viewers. That was, of course, Sam Hossack, the Managing Director of Prospect Resources, who took us through some of the finer details with regards to the operations of the firm. And now joining me in studio is our very own Chief Analyst at Equity Access, Respect Gwenzi. Respect, good evening and welcome to the Earnings Review.
My pleasure. Thank you, Eben, and good evening, viewers.
Fantastic.
Sure.
Now, Respect, of course, this would be an interesting firm to look at given
Sure.
their operations and, of course, what is playing out in as far as the lithium sector is concerned. I want us to, first of all, look at the details of the firm, then zoom out to look at the sector in its entirety. Now, Respect, this is a firm that has been in operation for a few years in Zimbabwe, and over the years has, of course, posted a series of losses. Can you just take us through some of the details where this very firm is concerned?
Yeah, so it's an exciting story from a Zimbabwean context, in that it involves one of the big projects out there that can actually propel the economy in terms of export process generation over the next few years. The project is now in development stage, and over the next few years it will start producing its first ore. That's by around 2022, and by that time it will obviously become cash flow positive. So the background of losses in terms of the prior years is mainly a function of high capital outlay that has to go into the development phase, as well as the phases before that. So I think it's an exciting project. It has also been offered it has also been granted special economic zone rights in terms of the country over the next 5 to 10 years. And I think that background obviously places it in a position where it can also lessen the burden in terms of capitalization of the project. But yeah, it's an ongoing series of development. They will obviously seek more capital from the market, and so as to see through the development phase before they start producing ore.
Fair enough. I just want us to have a look at the financials, to look at how they have performed over the past few years. It has been a series of losses that we've seen recorded there by the firm. This would be their performance in 2015. On the top there would be their revenue line, and at the bottom would be their profit and loss position. So from 2015 right up until 2019, they've been posting a series of losses. 2015 2015, their loss of 1.3 million Australian dollars. 2017, a loss of 1.31 million Australian dollars. But a key development is in 2018 when they acquire an 87% stake in as far as the Arcadia Lithium project, which is pretty much the game changer and has brought us to this point where we're saying this is a firm that has a focus in as far as the production of lithium, of the lithium metal, and moving right up until 2019, where of course we are seeing that $12 million loss. Respect, can you give us insight into these figures and perhaps a little bit into what we can expect from the firm getting into the future?
So I think from a perspective of revenue generation over the past, say, 4 or 5, I mean, since the company came to life, we cannot read much in terms of income generation at that point, because this is simply a capitalization phase. This is pre-mine development phase and then the development phase. And obviously there's a significant capital outlay that is going on, especially on the flagship project, which is the Arcadia Lithium project. But I think the blue lines that we're seeing there in terms of revenue generation, this is revenue coming from a bit of some gold operations, both in Panalonga as well as the Gwanda collection of gold assets that are there. But obviously that money is not sufficient to really cover for all the capitalization costs that are being incurred at the Arcadia mine resource. So I think this trend really speaks to the capital outlays that are not proportionate to the revenue generation, and the firm had to really rely on capital placement of shares, as well as also borrowing in order for them to finance the development phase of the lithium project.
Yeah, as you rightly pointed out, respect that there has been a significant capital expenditure that has been recorded by the firm, bringing us to this point. And according to their most recent DFS, which is a definitive feasibility study, there is an indication of a capital expenditure to the tune of $162 million, which is required to bring this very project to fruition. But I want us to look at a key indicator, which would be the share price. Now, this is a firm that is listed on 2 stock exchanges, the Australian Stock Exchange, as well as Germany's largest stock market, which is the Frankfurt Stock Exchange, particularly to look at how their share has fared perhaps over the past few months, given what's playing out where the company is concerned, as well as also some indications that are going on in as far as the lithium sector is concerned.
Yeah, sure. So I think what's quite important is to look at what this phase entails for the company. It obviously requires much to be able to get to a point where they start doing actual production. And before we get to that phase, there's still 1 to 2 more financial years. And it means that they have to get the capital from somewhere. So these various listings speaks to the company's efforts to try to raise equity funding for this very project. And I think operationally as well, they also need huge outlays. So as we get into the production phase, there's definitely a need for shoring up those cash flows. So what the company has been doing is to seek listing, also seek strategic partnerships. One of the key partners is a Chinese company which has agreed to an offtake of the metal for about 7 years, and they've agreed to also push in $10 million once a mill has been set up at the plant. So what this really means, I think from a funding perspective, is that there is still need for the company to acquire or to get more capital in order for them to ensure that they get to that point of production. So what we saw, especially in for the greater part of last year, is that the company's share price has been going down, but this has been mainly driven by the fact that investors were quite worried about the prospects of the company being able to acquire or to get that funding which it so needed. So from late last year, when the company achieved or managed to acquire some of that flow, I think that's when we saw that surge in share price. But getting into 2020, the share price has been coming off, But this is equally in line with the broader spectrum of how the lithium market is performing. We're seeing excess demand, especially being driven by China, and this has actually led to a supply glut of the lithium oxide, and this is what we're also seeing in terms of the prospects. So most analysts have now revised their targeted outlook price for the mineral, and it's I mean, over the next 2 years, it's anticipated that we might remain in an oversupply position, and we might begin to see price recovery maybe late in 2021, 2022, thereabout. So I think this really speaks to possibly a change in the spectrum in terms of the growth that expected from the lithium side. But I think also it speaks to demand in terms of real sectors such as battery, as well as ceramics and glass, which are some of the key sectors which demand lithium in their produce.
Let me jump in there. I would need you to expand on the factors playing out in as far as the demand for the product is concerned, which is of course lithium. How important is their recent engagement with Zimbabwe, because there is a development where the firm is set to access $143 million to fund the operations of the entity?
Yeah, so I think your question, does it really speak to issues to do with the price, or it's just about the funding?
This is now, of course, directed towards the funding, of course.
Yes, there are quite some prospects in terms of how Zimbabwe has come out to say we could possibly come in and finance some of the outstanding required amounts for this, but then that has not yet been concluded. So there's still that shadow in terms of what might play out in terms of funding. But it is hoped that it will definitely come to fruition in the next few months. But I think quite fundamentally the key drivers of what we are experiencing in terms of price is definitely oversupply of the produce. And this is mainly because demand, especially in China, has been dampened getting into 2020 and even from late 2019. I think these are some of the key drivers of why demand for lithium has been coming off, and there's been a slowdown in manufacturing in China. And even though we are now seeing a rebound in terms of production of in the EV market, still it's not the price has not yet corrected, and it's expected to remain weak for, I think, the greater part of 2020.
I want us to look at the chart for the chart for the lithium, the metal, how it has progressed in recent months, and what the progress has been. As you can see from the chart there, looking at how the prices have fared from 2017 moving right up until 2020, and of course those values would be in US dollar terms per ton, and this is exactly what we're seeing playing out where that is concerned. But there is an indication that we could actually see the prices rebound, as you rightly pointed out, north of 2021 into 22, as perhaps the demand there gets to restabilize. We have seen, but because of the pandemic over the past few months, a drop in terms of the demand for electronic vehicles, which has been one of the key drivers in terms of the demand where lithium is concerned. What is your take with regards to some of these key developments?
Yeah, sure. So I think in terms of the outlook, it's all analysts quite agree that there's definitely going to be a better outlook in terms of the price on a 5 to 10 year basis. And looking at dynamics across the world, most countries are now moving in to push in terms of electric vehicles and outphase the current cars that people enjoy driving, and that's going to lead to an increase in terms of EV demand over the outlook horizon. But in the short term, definitely this glut is likely to keep sustaining these prices lower. But I think we're coming from a high of 20.75, 20.74 in 2017 down to this June where we have about 5.73. This is such a huge decline, but it does not really take away the aspect of outlook. in terms of the price recovery. But I think one beautiful thing about Arcadia is that it's going to produce both in terms of spodumene and as well as petalite. I think this is a unique setup because there's no lithium mine across the world which produces both within one mining body. So what this allows is that in periods where you are actually anticipating that there can be an oversupply in terms of one EV market, you could possibly be focusing on glass and so forth, and obviously other areas as well. So petalite is mainly for the glass and ceramics market, while spodumene is more on the EV side. So you could rebalance the market, or you could feed into these dynamics and keep your supply level stable on the outlook. So I think it's not only just about the EV market, it's also about other complementary markets which feed into the supply of lithium. So it's quite strategic for this firm to be able to be producing these two sub-minerals within the lithium mineral body.
That makes a lot of sense, especially when you consider the fact that in as far as petalite is concerned, we're looking at about 155,000 metric tons of that very metal that the firm is looking to be producing on an annual basis.
Yeah, if it's able to achieve that, then that will take it about 12 years to be able to exhaust the mine life. So the mine life is estimated to be at 12 years. And using that metric in terms of what they can achieve per annum of production. But I think also more significantly, if you look at this collective capital outlay, which is upwards of 100 million, it can be recouped within 2.5 years. And this is not very usual for projects of this nature, because it normally takes longer to recoup your initial capital outlay, maybe sometimes 5 years or so. So if you are able to recoup your capital outlay in 2.5 years over a project that has got a 12-year span, it simply shows you the kind of upside that's there in this in the company. So I think all these dynamics really speak to an outlook which is possibly even more favorable, even if the prices of nickel gets to be the prices of lithium gets to be affected.
I realize. But at this moment, I want us to look at the electric vehicles market. This is where we are seeing a lot of activity. We've seen Tesla making quite an ambitious target of producing 500,000 vehicles annually. If they are able to achieve that, that would be a first. And obviously other car players are coming in to try and see how they can give competition to Tesla. General Motors, I know that Nissan last week released a new model which is targeted towards the electric vehicles market. And this of course would be the prediction of what we could expect in as far as that market is concerned. This would be a chart there presented by the valuates, which spells pretty much a constant average growth rate of about 23% from 2017, where that market was valued at $118 billion, to 2025, where it is estimated that we could actually see the market ballooning to 567 billion United States dollars.
Yeah, I think this statistic around what the outlook means in terms of demand for EV, it's quite bullish, and obviously the broader market quite agrees that that's the future. But if you're looking at what the dynamics in EU as a bloc, there's been legislation put in place already to outphase certain models of vehicles, and this is what's going to usher in the EV models, and that really speaks to growth in demand on the outlook. So I think legislation across the world is pushing this market, and looking at China, which is currently the biggest player in that space, they have been subsidizing acquisition of these EV cars, and this is one of the reasons why in 2019 we saw that decline in terms of lithium prices is because China, which is the biggest player in terms of production of EV cars, had to remove some of its subsidies in the sector. So it ended up affecting the price at which most of the vehicles were selling for. And obviously, when price goes up, then demand also equally gets to be affected. So there was a slowdown in terms of production ultimately, and this affected these supply dynamics. But all this shows you that this is where the world is moving towards, and obviously the time is going to come where we've achieved enough scale in terms of EV, and it becomes the vehicle for the future. And so it also speaks to this kind of growth that we are noting here of about 22.3 over a duration of up to 2025, and even higher for a period of up to 2040.
And of course, still in the same vein, the United States Treasury, I think in 2018, they unveiled a $2.4 billion fund, which is targeted toward promoting the electronic vehicles market. And it remains to be seen, given that we've got a pandemic that is playing out, how things would actually turn out where that particular development is concerned. But this is not only as you, of course, are aware, the only driver of the demand for lithium. There's also a demand for lithium in as far as rechargeable batteries for smartphones, tablets, and other electric gadgets. How much of an influence do you think that would have? And I think that would, of course, speak to the other chart that we have, which is targeted towards the rechargeable battery sector.
Yeah, I think rechargeable batteries are mainly, especially in the smartphone sector. But I think EVs are coming into account for a significant share of that demand. So really, if we are going to spread the demand for lithium, we're going to be spreading it from batteries collectively and going into other sectors such as glass and ceramic, and also medicines and so forth. And this is where I think sustainable demand is going to come from, and this is going to stabilize whatever impact is going to come from the EV side. So it's really quite an outlook, but obviously batteries are going to play a significant role, accounting for over 50% of this demand, say in the next 4 years or so.
So obviously this has a trickling effect, or a cascading one, where Prospect is concerned, where we could actually see tremendous results. I know for a fact that Prospect has said that they expect an average EBITDA of $165 million upon the first 5 years of operation. But this is perhaps before we really see a significant ballooning in as far as the demand for EVs is concerned.
Yeah, sure. I think for Prospect, what really matters for now is to try to concentrate on pushing up the cash flow position, ensuring that they have got adequate capital in order to see through the production phase. But also when you get to this production phase, the computation or the calculation there is to realize quicker growth in income, but also costs are going to go up beyond these current levels that we are recording. But we need to get to that phase to clearly see what the operation really means, if it can achieve the kind of targets that it is anticipating. But it's already a given. If you look at the Chinese company, which has given them an offtake agreement, they have agreed to take about 34% of their produce, and they're quite invested in the firm. This is the biggest in terms of petalite processing in the world. This is the biggest player in the whole world. So I think some of these dynamics really show you the kind of potential that's there. If you have an offtake agreement, it means you have created a market for your produce, and somebody is ready to secure your cash flows over a 5 to so many years of production. But also looking at what's happening globally, there are a lot of players who are coming into that space. New mines are being developed in the lithium space. So that's also a key note in the outlook to say this might lead to oversupply at some point. But if you also look at the motor vehicle industry and how so many players are dedicating to push their production to EVs, it also means demand is going to be growing at a rate which is quite quicker.
Yeah, Wood Mackenzie, they've predicted that by 2040 we could see 5 million fuel cars replaced by EVs by the time that we get to the year 2040. And Wood Mackenzie is pretty much bullish in their approach in terms of perhaps what we could expect from the EVs market.
Yeah, sure. I think I also tend to agree on that, to say it's inevitable, and like I've said, many countries are putting in legislation that support the adoption of EVs as the standard motor vehicles that must be used, and some of this legislation is taking effect in the next few years, up until 2030. EU will be moving towards EVs completely, and obviously some of the regions are also catching up.
Let's take it back to Zimbabwe. We have seen a bit of vagaries with regards to policies set by government that affect the mining sector. How important a role do you think government would need to play in terms of ensuring that we create the maximum value? I think we've got 3 players currently in Zimbabwe. We've got, of course, Prospect. We've also got Chimar. We've got a third player also who's playing in this very segment of the mining industry. How important a role would government need to play to ensure that we create value, considering that we are the 5th largest producer of the mineral resource across the world?
Yeah, it's quite important to bring the aspect of pushing private players into achieving their intended goals, together with the government's goals of achieving economic growth and economic stability as well. So for Zimbabwe at this critical juncture, it's paramount for the government to try to look closely at how it crafts its legislation, especially with a view of trying to promote the export market. So I think we haven't done much in terms of legislation. The legislation of yesteryear, which is the indigenization policy, was quite brutal on foreign investors, especially on the FDI side, and it really deterred most investors. And also looking at some aspects of governance that were at play, policy unpredictability also drove some of these investors away. And looking at how some of the royalties are structured and so forth, it definitely tended to impact in terms of managing to attract capital and even pushing these goals that these companies will be aiming to achieve. So now getting into the current dispensation, yes, there's been initial moves, one which was to repeal the indigenization policy, but also on top of that, they have actually, for this specific miner, given give them a status of national status to their project, and this means that they're exempted in terms of certain taxes and so forth, and even importation of some of the equipment that they're using in terms of their production. So that augurs well, that really speaks to the country's realization that the business can no longer be done as usual. So I think this is quite encouraging, and our government could even do more by identifying such critical players and giving them the necessary tax breaks and also the necessary support in terms of other legislation, so that those who want to finance the project from the outside, they will definitely also see the brighter side of doing so, that is in terms of minimal risk. And if you're looking at the company's valuation on the Australian Stock Exchange, it's quite undervalued, and one of the aspects really is the fact that most investors are also skeptical about the Zim terrain, and this speaks when you also try to get debt funding and also equity as well. So these are things which governments need to consider, despite the necessary political battles that they might be fighting to retain power. They also need to push for growth in terms of the economy.
Quite elaborate there, Respect. It's unfortunate we've run out of time. Thank you, Respect, for being with us on the earnings review.
Sure, thank you, Eben.
Thank you, viewers, for staying with us. Don't forget to like, subscribe, follow us on Twitter, Facebook, and to visit our informative website, www.equityaccess.net. Remember to catch us every Tuesday, every Thursday on this platform. From the Equity Access team and I, Danke and ciao.